All right. Hello, everyone, and welcome to this lovely week-long event here that David and Anka are putting out. I want to thank you all for having me here again, and I'll give you a little bit of an introduction. My name is Toni Hansen. I've been a full-time trader for 28 years now, since 1996, and started teaching in 1998. So, a lot of years under my belt here, and I've seen a lot of markets come in and out of favor, and a lot of traders come and go. And I want to share with you today one of my favorite strategies, and it is actually one I just exited a position here as I was logging into class because there's nothing like multitasking, right? So the position that I just exited, I'll show that to you here really fast. And that is the strategy that I'm actually going to teach you in today's class. So here is a chart of the 400 tick of the ES, and you can see my execution down there. I'll make it bigger actually, so you can see it a little bit better. So this is a 400 tick chart of the ES here, and here was my execution as we were coming off of the support level right here. And I just exited it. So let me pull that up over here and show that to you. So here is the continuation on it up in the upper right-hand corner. And what I used for my exit was this shift in the momentum or the rate of change in the price action there. And so that helped serve as a target point. I also used some Fibonacci, and I'll get into that here in a minute. Marina gave you a really good introductory background to getting started in trading right before I came on. I'm going to touch on some of the same things that she shared as well and discuss a little bit of my trading history here. So, when I got started in trading, there wasn't a lot out there for education. There wasn't a lot out there for mentors. Most traders that I knew were still floor traders. So, that transition from the floor to online trading was just kind of in its infancy. I mean, it had started, a couple of years early, but it was really, really in its infancy there. And so when I was trying to figure out, well, hey, how do I trade? How do I know what to buy and what to sell, what to hold, what to let go of? It was a lot of trial and error. And there weren't a zillion indicators back then, here these days it seems like everybody has their own indicator and there's a million of them out there to choose from. And there's basic ones and then there's variations on the basic ones. And what I found came down to is, like Marina mentioned, you go back and you focus on pure price action and you learn to read the emotions of the market, emotions of people as they're depicted on the charts. And the only indicator that I use these days is Fibonacci. And I use that to help newer traders and as confirmation too, even for my own trades. But you're not, or I'm not, and hopefully you're not, focusing on using just one indicator in your trading. Every setup in the market is like a puzzle. And you've got to have all of these pieces coming together. And if you're starting out with a puzzle without a picture to show you what the end result is supposed to look like, you've got all of these pieces here. Well, as you start to fit them together, that bigger picture is going to start to come into view. And the more pieces of that puzzle you have, the easier it is for you to predict what that bigger picture is going to be. So when we look at technical analysis, I am looking at things like trend placement. So where's the strategy at in the trend? And I love reversal patterns as well. It's one of my favorite ways to trade the market. I like to get in as a new trend is starting and exit it as it's showing exhaustion or coming into resistance, just like what you see up there in that right-hand corner. And so I'm looking at trend placement. I'm looking at momentum, which again was a key to exiting this position here just a couple of minutes ago. I'm looking at support and resistance levels. I am looking at volume. Volume is really crucial to helping understand, hey, is this zone of congestion something that has a high probability of leading to a strong breakout? Or is it a zone of congestion that's going to keep on going and being a messy market? So I don't want to trade some of those earlier setups. You'll notice my entry here on this ES was very low. It wasn't a pure breakout. If I was looking at this as a pure breakout trigger, it would have been to take that channel break as an entry. And I was in long before that bigger channel break. Oh, I do have something that I kind of disagree with some other traders on here, and that's the use of market orders. So if I am using a setup in an early stage before it has given a full breakout of a trading channel, I'm often using market orders. Or if I'm going in long, I'll take the ask, which is the higher of the two prices. If I'm going short, I'll take the bid, which is the lower of the two prices. But I'm also not at odds or don't have a problem at all with using market orders under certain conditions, meaning I'm getting in at earlier levels before typical traders are coming into play, before you're seeing that full trading channel breakout. So, my class today is going to focus upon this strategy or a variation of this strategy that's actually a cleaner setup than what you're seeing here. And it's called a Phoenix. And I've been teaching this same strategy for well over 20 years, you guys. And it's to this day remains an incredibly strong pattern. So other patterns that you'll know that have the Phoenix in it will be an inverse head and shoulders or a cup with handle. So in those two strategies, your inverse head and shoulders looks like this. Well, your Phoenix is this portion here. In a cup with handle, the Phoenix is the handle. So what we're going to dive into today are the specific characteristics that we want to look for in that zone of congestion that indicate that this is going to lead to a strong continuation of that initial move off of the low. So a strong secondary upside move is what I am aiming to try to capture when I'm trading the Phoenix setup. Let me clear this here. And I'm going to go back to my PowerPoint. I might come back to these two throughout the session, but we'll go back there first. So like I said, I've been trading for 28 years and teaching for 26. And I have taught for many groups and written for many, many publications over the years. So if you want to dive into my system of market analysis, all you've got to do is Google me and you're going to come across a lot of free videos that you can learn from. But if you want to get into really advancing your analysis, your setups, your trading, I do offer one-on-one coaching, one-on-one mentoring, where basically I analyze your style of trading and help you progress within your own, I guess it would be where your own abilities are, how can we go and enhance those abilities and tune you into things that you might be missing and create even stronger strategies. I trade a ton of different types of strategies and many variations of strategies. So the Phoenix that I'm diving into here today, you'll see a lot of variations, like the one on the ES here this morning. So the core class today, though, and the core classes you'll find online really easily, go into the basics. And from there, you can just keep learning. You guys, even this many years later, I'm still learning. I never stop learning. There's always something new, um, observations you can make and new markets that you can dive into and start trading. So this is a pattern I've taught again for a good couple of decades here. And it is, again, a core reversal strategy, but it's the early stages of those reversals. So these are key traits or characteristics that you want to look for when you're looking at a Phoenix. And this is actually one of the traits that is on the screen here really was not present in the Phoenix that I took on the ES. And that is, let me put that back over here again. If we're looking at our trend here, we want a strong downtrend. So something that has had a good couple waves of selling in it. So for example, if we look at, I've just got the Dow open here, you can see the Dow had three strong waves of selling this morning, shift in momentum here. This is the Phoenix. So you got that strong downtrend, and then you're looking for a break in that trading channel. So the reason that we want to see that break in the trading channel is that that means that when this Phoenix over here triggers, we're going to have a greater potential for strong impulse move and not just like another smaller bounce where within that channel it could end up going lower. So what we want to see is that main downtrend channel. And on the ES, it did have that channel and then the break you can see over here. Then we want to look for an average to stronger than average move off of the low. So if you look at the 400 tick chart on the Dow or on the ES over here, it's a pretty average momentum move on this time frame. I would consider it to be above average though when we go up to like a time frame chart, like a 5 minute or even like a 15-second chart. You can see kind of that stronger start, but average to slightly above average is what you're looking for to start a Phoenix. And ideally, what you want to see are two smaller impulse moves. So on the ES over here, we have one initial main impulse move, but the second one kind of gets a little stunted and then goes and finishes up. So that second wave has two smaller waves in it. So that's a little bit of a variation there compared to the template. Another variation that you'll notice is that in a Phoenix, for a core template trade, you want two waves of corrective action. And ideally, that whole pullback there should be slower than the upside move. So you want a stronger move, a little bit slower upside move, and then an even slower correction for the core template. So what you'll see over here on the ES is that this did a little bit of a variation. It went and it pulled up a little bit further before it did the two waves of correction. So it's not that pure core setup, it's a variation on that setup. But you do have a lot of the same traits. So we have that somewhat slower upside move here. And then if we go and transect that pullback over here, we have an even more gradual correction that came into place with that core setup there. So these are some of the basics that we want to look for a Phoenix. And when I'm looking at an entry trigger on this, what I want to see is a break in that secondary pullback. So on my ES, I didn't do that because that was still a little bit of a stronger move. I took the smaller little kind of double tap of the low and that breakout as my trading channel entry. So instead of using like a full consolidation break with an entry here, I want to use a smaller time frame channel break as my entry. So ideally, these two waves of correction are going to be approximately the same size and approximately the same momentum if we have a course setup. And then that break of that smaller channel there is going to be my entry point. My stop is to use the absolute low, pull it up to that second low there, and I'm going to keep my stop under that trading channel right there. So what this does is it gives me a stop that is immediately starting to move in my direction as the trade begins to move. So instead of guessing, how much room do I need to leave for potential retests or flushes and risk giving back everything and then some on a trade, I'm not going to be using under this second low as my stop because if that pulled back there, look at that difference between whether if I use the channel break or if I use under that absolute low. That can be a pretty significant amount of money that gets to be stuck on the table there when you haven't actually increased the odds that you're going to be able to hold on to a position. So in a Phoenix, that channel is what we want to use as our stop parameter. Move this out of the way. Now, a typical target coming out of the Phoenix is going to be another two-wave movement and looking at a measured move. So this upside move here in green, basically what we want to see is a repetition of that move, and that's going to be the target zone. You'll notice I used a little bit of a different target zone here today on the ES. It didn't have the solid two waves of continuation because it didn't have the pure clean two waves to start with. Let me actually, I'm going to go and grab my chart off of my other screen and, well, you know what? No, I can just do it on this. Hold on a second. Pull it back up over here. And I'll put that 100% price extension on there for you. So Fibonacci is basically just an extra tool that you can add as another visualization cue. So you can, of course, just eyeball a lot of Fibonacci levels, and especially once you get used to using them, I'll even eyeball where the fans are going to be, and literally I'm usually within a couple of ticks of where those Fibonacci fan levels will be. In fact, did a session yesterday, drew the fan line on there, and then went back and use the actual indicator, exactly the same levels. So your mind gets taught into where those price points are going to be. And here you can see that shift in momentum that I used as my target level was also that 100% price extension. But you don't quite have those clean waves of momentum on the upside that are as easy as the template. So when you start trading a new strategy, always start by focusing on the ones that are as close to the template as possible. And then you can start experimenting or sim trading with different variations as you become more and more comfortable with the strategy. So I love that the market was so kind to offer this setup right before our class. So you guys got to see a variation of it basically playing out live right before our session. So here is one example of a Phoenix as well. And this one is part of, it's a strategy that I love where we've got two waves of selling over here, and then we go into three lows, and then we get the Phoenix. So this is a very specific version of the Phoenix, where again, two waves of selling, three lows, channel break, and then here's your Phoenix. So your first initial move was a little bit stronger on this one, and then the second one basically consisted of a zone of congestion. What you'll notice though is that when you're connecting these highs here, that breakout trigger there has approximately that same amount of difference between the highs. And that was something that was a trait of the ES here this morning as well. When it went to break higher, that spacing between the highs on the pullback was about the same. It's pretty darn close. So that's another trait to look for. Equal highs. And then, let's clear this. You'll notice that the entry trigger that's circled is basically your smaller channel break as the entry trigger, not waiting for this bigger channel here. This is where using a market order would be very detrimental to your health if you're using a full breakout, because a full breakout means that it's coming in and testing previous highs, previous resistance levels. And what tends to happen is that as soon as that channel breaks, a lot of times that will lead to a pullback or a zone of congestion, especially if you're coming off the middle or the lower end of the range of a Phoenix. So that would be a level that I would say, yeah, no, I don't want to use a market order for something like that. But where I would use a market order would be if I was looking at each of these highs within this congestion, as this is pulling down, I would have a stop market buy order above each of those highs so that when that channel breaks, my market order triggers immediately and I'm going to get a much better fill than if I wait for the break and use a limit order as it confirms. So that is a crucial difference in terms of whether I want to use a market order or whether I want to use a limit order. If I miss that initial trigger, I'm more likely to use a limit order because I'm going to be building into the position in the congestion instead of right on the breakout of that trading range. That's that highest risk level for using a market order. And this is why you'll see traders like Marina say, don't use a market order because, yeah, if you're using it as a traditional breakout trigger, you're going to usually end up, well, maybe not usually, but from my experience, really darn close to an absolute high, only to see it pull back on you before it then tries to continue. Or if your analysis is wrong, you just bought the high. So the nice thing with the Phoenix is you can get in at a pretty low level. And even if you're wrong and the position doesn't end up working out, a lot of times you're still going to be able to end up with a break-even trade or very small losses, just because you're not only getting in before the full channel breaks, but you're also getting in with a stop that is moving in your direction. So as that trade moves, you're going to have both of those as your advantage. So if something just isn't going, you can partial out part of your position. And if the rest of it stops out with that adjusting stop, you can still end up making money on the Phoenix on something that technically ends up being a failed Phoenix. So here's another example from this week. This is in gold. And this triggered really early on in the week here. And what you'll notice is that we again have those traits that are, and this is the exact same setup that we saw yesterday on the Dow that took the Dow coming off of lows for a really strong movement yesterday as well. And it has that channel break. And then you've got that pretty average momentum move on the upside, little bit slower than the downside move. And then your two waves of correction, which lead to that slower momentum here. If we look at our distancing between our highs, we are right smack at the do or die zone for that as a buy setup. Now, again, this, if we just connect these highs here on that second pullback, that's not as good of an entry. You know, it's really close to where that full channel break entry is. So if I see a smaller setup with a smaller correction, I'm going to use that as the entry trigger. That's what you saw me do here with the ES this morning. In fact, it was the exact same thing. It retested the low. I'll pull that back over as a reference. So see here, it went retested that low. And if I had used like connecting those highs, that would have been a pretty big range there. So this move, I didn't use a breakup because the momentum was still pretty strong on the downside. So I waited for the retest to use that as the entry trigger and the channel break of that retest. And that's the same kind of idea that you've got going on here on gold as well. Now, gold was a great example because when it broke out, it had stronger momentum, just like what we saw on the ES here, but it didn't have that shift that we saw on the ES. So that shift into that 100% zone, that's what got me out of the trade on the ES. On gold, it's a sharp move, and then it does a pullback. So what that tells me here is that gold has more room to keep going. And that's the same thing that the Dow did yesterday as well. Let me see if I can have a chart of that up. Mentioning things, and it's better if I actually show you it as it's happening too. Here's a Dow chart. So you can see the same pattern yesterday. So this went, it does have a little bit of a shift, nothing substantial, but I was able to go and do a little bit of a pullback and continue. And I was looking at the other indices too, and the NASDAQ actually had more of that pattern that was similar to gold, where it did a price pullback and then the continuation. And I was talking about that live during our session yesterday. So I teach live market analysis every day at noon for an hour. It's called League of Traders, and you can find that on my website. It's just ToniHansen.com. I did a little bit of a hiatus here over the last couple of months. Took a bit of a break from the teaching aspect side of things to deal with some personal stuff, but I am back full time here this week. So if you want to join me, go check out ToniHansen.com and click on League of Traders, and that will get you into the live session. Well, we'll see all of this analysis basically live in real time during our classes. So I teach as the market is actually unfolding. So you get to see not only setups that are developing, but also weigh all of the pros and cons that I'm looking at. So here's just another chart. And what this chart shows you is how Fibonacci comes into play. So when you're using Fibonacci as a timing tool for entering a Phoenix, what I want to do is I want to take an average momentum move. I'm going to go from the low to the high with my Fib fan. Now, not every platform has Fibonacci fans. Every platform tends to have Fibonacci retracements and price extensions, but not guaranteed fans. So if you're trading on NinjaTrader, I developed an add-in for Fibonacci fans where we can go and let me show you. It's called Trade Tracker, and I keep it really cheap so anybody can go and add it. It's just ToniHansen.com/trade tracker. So this is what your Fib fans look like here. So you'll take that from the low to the high as long as that is an average momentum move. And that's going to give you the zones that you want to watch for a continuation move. And on the 400 tick chart, it's a little bit different. So you'll want to look at those spans on both time frame charts and tick charts because sometimes they can be a little different. But that general zone then became the zone that I wanted to see as a target level for entering the position. And what that does is it also gives me a level of support where if I want to hold a trade longer term through corrections, I can keep my stop adjustment continuing to ride up along that fib fan. So fib fans are a great tool in helping you avoid early entries on things like a Phoenix setup. And my line charts are a little bit different than if you're using a full candlestick chart too. You can get a little bit of a different price, but I've noticed that it's not really off far enough that it makes a huge difference. So I don't usually go and double check on a candlestick chart. So Fibonacci fans are basically showing you changes in price over time, and they provide support and resistance levels as well for when we're looking at new setups and new strategies. So, why they're important is because they hold extremely well. And they're also rather forgiving. So if you have one trend where you're drawing your lows to highs and another person is looking at a bigger trend, lows to highs, oftentimes you're going to get overlaps in your fan levels. They might be different fan levels, like a 61.8% for one chart might be 38.2% on another chart, but they tend to overlap really closely. And they give that extra vote of confidence to a trade. So you know that, hey, if I take something that's coming off of a fib fan and I have all of my other ducks lined up in a row, I have a really strong trade. So do I have those two waves of correction on my Phoenix? Do I have that shift in momentum that is going to favor a Phoenix? So do I have that slightly slower and then slower still? Take my fib fan from here to here. And then that 76.4 is the fan level that I want to look for to find an entry point or an entry trigger. So on NinjaTrader, it's called Trade Tracker. So go to ToniHansen.com /trade tracker. And it's just $79 if you want to add it to your charts. And I also have a bunch of classes um, that are in that section as well that show you how to use it. And Fibonacci fans, you can get much more advanced, just like with any initial setup. So I do dive into how to make those adjustments with your fib fans so that they hold over time as well. Again, I don't use any other types of indicators anymore. I don't even use moving averages, which is like one of the core indicators that people are taught from the very beginning. I don't use them. And it's because they tend to give you a lot of false trigger points. And if you're using fib fans correctly, the way that I teach them, you're not going to have a lot of false entry triggers. You're not going to have a lot of false points of where, hey, the fib fan is here, but it doesn't hold. So here's just another example of our Phoenix with the fib fan. So I've pulled examples from over the years. I usually just update my classes to show most recent trades and actions that again pull from previous classes that show you how well the system holds over the years, where it's not just something that is working in today's market, it is something that works in every single market, every single time frame, every single security you want to trade. Your Fibonacci fans are going to work in them as long as you use them properly, meaning this has to be an average momentum move. If it's an extreme move on the upside, your fib fans are not going to work. They're going to be useless. So as long as you recognize that as an average momentum move, which means generally speaking, if there's a lot of overlap and then these short impulse waves within that, that's typically going to be an average momentum move. If you're looking at a V in the market, odds are that is close to an average momentum move, but you do have risk that it might end up being stronger than average. So this over here is stronger than average. So I wouldn't use a fib band from that low to that high, or even that low to this high on this, because it's not likely to work as well. In fact, you would want to keep the same fib fan as support for potential continuation there later on something like this. So here's an example of that. The initial upside move, the correction. So you'll notice stronger impulse move, a little bit weaker, a lot weaker. We don't have the pure two waves of correction here though. What we do have is a decline in volume. So this is after hours trading. And you'll see that the volume decline is pretty significant when it gets to this other end over here, this very last portion. So within the Phoenix, that is another pro that you can add to your template. Volume declining throughout that two waves of correction. So this is a variation where we don't see really clean two waves of correction, but it's still a Phoenix. So trigger point, moving and adjusting stop, and then that zone serves as support again for a secondary continuation as well. If this had not quite hit that fib fan, we would have what I call a no touchy, and that's actually even stronger. So if it comes close to that fib fan level but doesn't quite tap it and breaks higher, that has a greater chance of doing an extreme impulse move where it can go and double or even triple those previous two impulse waves. It has to get started immediately coming off of that second test of that zone. So what you'll see here is that the struggle to get going coming off of that, it shifted the momentum compared to the previous impulse move. So that means you've got to pay more attention to those two waves of momentum and look at those as measured move levels for a new target zone instead. And in this case, this is from a while ago, but I used the break of that channel to flip the trade. And you've got the confirmation over here with the break of that Fibonacci fan. Once that fan breaks, it becomes a resistance level. So you can also use it to time pivots that can lead to a continuation on the downside once that fan breaks. It's like any other type of support or resistance. Once it breaks, you flip it. So if it's support, once that support breaks, it becomes resistance and vice versa. And if you look at the ES right now, oops, grab my other thing here. You can see how that became a support zone again. So it offers another opportunity for a second setup. So this is a really good example of it here this morning. And then here on this chart, this one is closer to a traditional Phoenix. A little bit of a difference is that it has a double bottom kind of coming in here in play. Here's our impulse move up, breaks that trading channel. So technically, that channel zone would become support as well. We've got a two-wave correction right into that Fibonacci fan. If you want to get really aggressive, sometimes I'll even actually put an entry at the fan so that it gets filled as it's coming into the fan level. I'll do that if everything is lining up on multiple time frames. But in this particular instance, you can see that I waited for that smaller break and used that as my entry point to get into the position. Since it came up here pretty quickly into 76.4% price extension, that tells me I'm going to have a really good shot of making it to the 100%. So I don't need to worry about trying to get out a little bit early or anything like that before it gets to that 100% extension there. And again, look at the volume down here. So this whole zone of pullback has lighter volume than we had seen earlier in the morning. But in particular, you've got that drop right with that last little zone of congestion. And so in this case, it does correspond pretty closely to where that breakout is. You've got a really close little trigger point in there, but it's not perfect. Here you can see a little bit more detail of what I used as the entry points. So I used the smaller two-wave correction and that channel break, and then added into it with the smaller channel break here. And then I had multiple exits and re-entries as I was managing the position up there as it was coming into 76.4. You can see it did a little bit of that shift like what we saw on the ES this morning. So in that case, I used it to protect part of the position. So if something's stalling at 76.4 though, there's a good shot that it's going to make it to the 100%. So I went and added back in and built back into it. But it protects me against a flush like what we saw happening this morning on the ES, where it came all the way back to that fib fan level. Here's another example. So you'll notice that in this case, we got what we call an avalanche. So an avalanche is just the reverse pattern of a phoenix, and it has that same type of formation that we would see with the head and shoulders, except we don't have a clean shoulder over here. We have that shift into the highs instead. But the time development is really good for getting a shoulder. So just like you have your phoenixes, you can flip that pattern over and end up with an avalanche instead. So here's just another look at the previous slide or previous trades, and that shows you the fib fan there, where you can use that as a sliding stop if you look at it as a longer term hold too. In this case, I had flipped it. So another closer example, there you can see my flip a little bit closer, building into the positions and then adding into the short. This is your avalanche. And in this case, the target level was a 3-wave, right back into what we call a T3 target level. So here's where fans can really help you out, because you might think, oh, hey, I'm taught 2 waves of correction. That's going to be a good buy trigger, right? Well, look at that. It triggered, but it couldn't make it really through that previous high. It got stuck. And the reason for that is that the fib fan is not ready. So your fib fan tells you, hey, this didn't make it down to that 76.4%. I don't want to take a trade that is this early, because there's a better chance that it's going to end up stopping out. And then when that fan did end up breaking, you can see it came into it really strong. So when it comes into it really strong, that's where I like to get kind of little double tap, like this morning, because it has a better chance of giving me stronger follow through than if it just bounces right off of the fib fan. Sometimes it does bounce right off the fib fan without double tapping, but your odds are much more favorable if it does that little baby kind of double tap. Again, I'll show you that here. So see here, it's a stronger than average move on that second pullback. So getting a little bit of that double tap coming in is really crucial. Over here though, it didn't double tap. It just came off of that low and just been kind of steadily puttering higher since then. So again, you guys, I do offer private mentoring for those that are interested in me analyzing your own trades or helping you teach you more of the in-depth details that go into these strategies. Just opening up my chat button here, and I'm going to come back and we'll take any questions here in a little bit. I didn't have my chat open, so I'm sorry if I missed some questions along the way here. But once that fib fan breaks, that's going to serve as a resistance level. And you can also use things like, hey, I want timing for an inverse head and shoulders too. So if this tries to break right here, well, look at the difference between this low to here. I want even spacing. That's too early. So in addition to the fan telling me that that is too early, I've got time development between my lows that is telling me that it is too early as well. But I see so many traders being taught, oh, you buy a two-wave correction. Well, sort of, yes, but again, that's like one puzzle piece, right? You can't tell me what the entire puzzle is going to look like if I don't have a picture and I'm only dealing with one puzzle piece. So here's that time development aspect. And then here's just another example of where, again, I use that fib fan as a target level on something where it had broken the fib fan. So it served as a support level initially. Here, again, this is a variation that was closer to what we saw this morning. So it had the two waves up, a little bit of a higher move. Used that absolute high for my fib fan. And then that served as the support level. Made it to the 100% extension, did it with another two waves. Again, that second wave had two waves within it. And then we've got a two-wave correction down here, three lows, and a baby phoenix. So this is a core phoenix setup here, but the trend placement is a little iffy. So when it comes back up to that 76.4% as a fib fan, that serves as a target level. And here's what it looked like on the smaller time frame. So you can see again, fib fan zone and the smaller time frame setup in there. And then the fib levels can also help serve as target levels too. And then really light volume right before it took off there too. I do a lot of trading in the middle of the night, you guys. I like things peaceful. Usually I trade the most first thing in the morning or late at night. Clear this. And I'll kind of speed things up a little bit for any questions. But here's another example of a phoenix. The two waves aren't clean here, but you do have the volume dropping. And then you've got that smaller zone of congestion here that you can use as a stronger trigger. So in this case, again, that is a fuller channel break, but I'm not going to go and hit a market order when that channel breaks. I'm going to put it on as a market stop order. That means as that channel breaks, it hits a market order, but I don't have the delay of waiting for the break and then hitting a market order. That's when you end up with horrible fills at like the top of a bar, only for something to come back and pull back. So again, very important distinction there when I'm using market orders. So I'm using them as basically a buy stop where as it's developing, I'm moving my market order lower above each of those highs so that when it fills, I'm still really close to that absolute trigger point and I'm not waiting for the channel to break and then hitting a market order where I've got a delay just because, hey, I'm not Speedy Gonzalez. So be very, very careful with that. So traditional stop would be under that channel. The stop I'm going to use though would be under this channel. Again, here's another look at things. This was a measured move target with that previous trade. And then here's another example of showing, I guess, showing off and patting myself on the back here, right? Because this is from this week. So what we were looking at was the breakdown from the momentum movement over here. So you've got that channel break here. And then we were looking at the distancing between these lows. This was live in class this week. I believe this was even yesterday or the day before. And then that 100% extension for the price extension is right here. So what you've got is that equal distance between the lows, and that made this a do or die spot. It had to go at that point. And sure enough, that's exactly what happened. Now, we followed this live in class and looked at why this was a support level as compared to going to 100%. So this is a 50% price extension. When you've got a breakout, you don't want it getting stuck at a 50% price extension. It should make it to 61.8%. Otherwise, the odds of making it to 100% are very slim unless it goes and does a smaller congestion again and continues. So we were looking at this as, hey, you know what? This isn't good, what is happening here. And it actually formed a little baby phoenix right here for a buy setup. So then what we were looking at was, okay, well, where's the next place that this can go and give another setup to continue this move after this short? And that was the drawing that I did here. So this was the predictive drawing that I did in class. And then this is what it ended up doing right here. So it had a little bit of a stronger pull up than what I originally wanted to see, which actually makes the breakdown a little bit trickier. Timing becomes a little bit more difficult. So I actually ended up catching part of the continuation move, and I missed the early stages because I kept kind of second guessing where to enter on it. Like I knew this was the resistance level that I wanted, but there wasn't a great smaller time frame setup for it. So the nice thing though is again, even if you don't catch that first entry trigger, you've got a stop level that's declining with you. So it's easier to go and say, you know what, I'm going to build into a position and my stop is going to be moving with me to help with that position. So those are just some live trade examples here from today and then earlier this week, where you can see this setup that I've taught for years still in play. And I do have a mentoring program that you guys can get on demand right now. It is $200. It is ToniHansen.com/Phoenix. And it goes into everything that I talked about here today, but it goes into it in substantially more detail. It shows you different variations of the trades. It shows you things like adjusting how to use your Fibonacci fans in different circumstances. And you're going to get many, many more examples. So it was over the course of 3 weeks, but it's now available all on demand. So technically, you could sit down and binge watch it if you wanted to, or you can go and watch it through once and then watch it through again in a couple of weeks as you're starting to apply things. And I always recommend going back and re-watching classes that I teach because you're always going to pick up on something, some little detail that you missed the first time or the second time around. And those little details can be very crucial in determining winning versus a position that struggles to win. So we're also looking at, hey, how do I know that I need to cut my loss on this one or to jump out of something that it's up, but it's not up as far as it should be? And that's where those building blocks come into play. And so it dives into things like the trend development and time development aspects of a Phoenix into a lot more detail. So I want to thank David for having me here today and Anka, of course, as well. And I hope you learned a lot in this session. Does anyone have any questions there that I can answer for you? The link for Trade Tracker, let me stick that in here. So that's just ToniHansen.com/Trade Tracker. And that should work for getting you that add in for those of you that want to add Fibonacci fans to your Ninja trading charts, Ninja Trader. And that's a pretty good platform for traders of many different markets. So it's pretty stable no matter what market you're trading. No questions? Well, thank you, Scott, and everyone for joining me. And I will let David take on over then. And I hope to see you all around next time.